Good morning, Real ECN listeners. This is your Forex market commentary brought to you by Real ECN. Today is Friday, January the 24th, 2014. In line with today's discussion, we're going to talk about the trend breakout in the euro-dollar pair seen in yesterday's European trading sessions. If you're sitting on the long euro-dollar position yesterday, prior to the breakout, congratulations on your winnings. And you're probably wondering how to formulate your trading strategy from here. Hopefully, this commentary can provide you with some insight in doing that. First in line, we're going to look at the technical front in the euro-dollar pair. The euro-dollar market broke out to the upside yesterday on the better-than-expected PMI numbers coming out of Europe, coupled with the disappointing U.S. existing home sales and continuing jobless claims, prompting speculation that the U.S. recovery may be losing momentum. The pair bounced from session low of 1.3540 to close at a session high of 1.3695 level. In order for this bullish trend to continue to trend higher, the pair must trade above the 1.3745 level next week, which is at the Fibonacci 61.8% level. Of course, the maintenance of this momentum is greatly dependent on the rest of event data coming out of the US next Tuesday, which is US durable goods order for December, as well as US consumer confidence for January. An analysis of a collection of technical indicators on the hourly interval on the euro-dollar market suggests a temporary bullish market sentiment and recommends short positions on the greenbacks. The hourly chart established short-term Fibonacci resistance at 1.3703 and Fibonacci support at 1.3689. The euro-dollar market once again surprised the market by breaking out of its Bollinger Band compression to the upside, which allows us to trade above the 200-day simple moving averages for the first time in a week. This new price discoveries allows investors to revise their long-term bullish outlook on the euro if it continues to trade above the 200-day simple moving average. Remember, this trend action holds great significance as the 200-day simple moving average contains more or less of 1 year worth of trading data. This bullish market sentiment is also validated by the euro-dollar pair opening today's Sydney trading session above the 5, 10, 20, and 30 simple moving averages, which is indicative of a buy recommendation on the technical chart. So now let's closely look at these technical indicators on the hourly time interval. First of all, we have the MACD, which is the moving average convergent divergent. Right now, it has a positive price value of 0.002. It implies that the 12-day EMA is sitting above the 26-day EMA, with technical recommendation of a buy. Moving down 2-3 notches to CCI, which is Commodity Channel Index, it confirmed a buy or sell signal. Right now, it has a price value of 110.4. Remember, when the price value is above 100, it's a strong buy signal, and it shows the market is trending upwards. And in line with that consensus, it has a technical recommendation of a buy. So, second to last technical indicator we're going to look at, which is the ultimate oscillator. It's a momentum oscillator, and remember, if the price value is above 50, it shows that the trend is in a bullish upward trend. So right now it has a price value of 71.308 and technical recommendation of overbought. Lastly, we have the bull to bear power ratio. Right now it shows that the bull is still in control with price value of 0.0071 with technical recommendation of a buy. To total it up, out of our 10 technical indicators, we have 7 buy, 0 sell, 3 neutral with technical consensus of overall of a buy. Moving on to the fundamental front, yesterday's upbeat Eurozone PMI number has given the euro-dollar pair the momentum to break up from its congestion trading range, which it has been trapped into since the beginning of the week. Germany's, the Europe largest economy and world third largest export nation, reported a better than expected PMI reading of 56.3, beating forecast reading of 54.6. The general Eurozone PMI are positively beating expectation, with manufacturing reading out at 53.9, beating estimates of a 53, while service PMI rose to 51.9 above the forecast of 51.4. The reason behind this buying pressure in the euro is an upgraded speculation in the ECB to hold off implementing further monetary easing policy and allow the Eurozone member to recover on its own. Since the forex market is largely trading on confidence, investors' confidence couldn't be any higher. This begs the question, is the market confident in the euro large enough to provide it with the momentum to carry through with this upward trend? Eventually, it comes back down to relative monetary policy. The ECB continued to remain accommodative on its easing policy and is a far cry from any rate hike, while the Federal Reserve are implementing its tapering program. The market are also paying close attention to next week's FOMC meeting to determine long-term euro-dollar trend direction. Over in the US, the US Labor Department released its initial jobless claim, which falls in line with market consensus last week. Nevertheless, the wildcard that played into yesterday's greenback weakness was the continuing jobless claim report that stubbornly remained above the 3 million marks, sitting at 3.056 million, ticking up from a previous week of 3.022 million reading. This number also raises concern in the market as traders fear that this number, along with the recent disappointing U.S. non-farm payroll number, is sufficient to hinder the Fed's decision and dismantle its QE program during the next FOMC meeting. This mixed economic reading leading up to the week's FOMC meeting only have investors second-guessing what the Fed will do next. In the case that the Federal Reserve Voting Committee continue to remain hawkish on its monetary policy and believe that it's tapering of its QE program by another $10 billion is the next best plan of action, this can be enough to dampen the surge of euphoria seen in the euro-dollar market yesterday.